If there's one thing that we love to do around here, it's find value in stocks that have been beaten up pretty badly recently. And today we're going to talk about a stock that was trading at $300+ during the peak of the pandemic and is now down to just $10 a share. And I don't even know why I'm even like teasing it, because you could probably see it in the title, but it's going to be Teladoc, ticker TDOC. So without further ado, let's get into it and talk about why we think we've got a good opportunity with this one. Welcome back to the Hourglass Trader, where as time passes, we make money. All right, so here we go. We've got to jump all the way back to the 5-year chart to get a peek at the peak of this stock price, no pun intended there. But back in February of 2021, this thing peaked at $308 a share. Fast forward to current day, we'll go back to the 1-year chart. We've got this thing down at $10 a share now. And this thing first came to our attention because the RSI is just so low right now, right? It's this bottom section that we have right here. It measures if a stock is overbought or oversold. If the RSI reading is below 30 on a stock, that means it's oversold. And typically, from a technical analysis perspective, depending on how much weight you want to put into that, is primed for a little bit of a bounce. So we can see it's been pretty beaten up just over the past year, but the last time that the RSI got this low was back in September of 2023, where it got to about $18.50 a share. And it traded relatively flat over the next month, which is an important point for later. And even though it dipped down to 15 at one point, it did bounce back up to above $20 a share by the end of the year. So that's why we like to use RSI as a good indicator for when we could potentially get in on a stock. And right now, that's a pretty big green light. But of course, when we come up with the bullish thesis or want to initiate a position in a stock, we want a little bit more than that. We don't want to just say, oh, this looks good, let's fire away. We want a lot more behind that. So let's talk about the other things from a fundamental valuation perspective that we really like about TDOC. All right, so up here we have the 10Q, which is where we're going to start our little search here. And what do we like so much about this company? If we get onto the consolidated statement of operations, aka the income statement, we're going to see that for the first quarter of the year, the 3 months ended March 31st, 2024, they had $646 million of revenue. Now, if we pull up our system calculator here, we're going to see $646 million times 4 quarters over the course of a year is going to get us to about $2.584 billion of revenue. So what's significant about that? If we look up TDOC stock, what we're going to see is that they have a market cap of $1.7 billion. So this company is bringing in more money in revenue than the stock is worth in the open market, which is fantastic. So that's a major positive. Now, if we scroll to the bottom of this, though, we're going to see that they have a loss of about $83 million. So from a price to earnings ratio perspective, that's going to be a negative number. So that's not exactly where we would like things to be. But again, not everything is going to be sunshine and rainbows with a stock that has a chart that looks like this over the past year. So what we're trying to do here is understand why that's happening and understand why we could potentially put a positive spin on some of this and understand why we think that this is a good value stock. And the first thing on here is we want to understand what's actually driving this loss, because we see revenue of $646,000. We see some expenses on here that are in excess of that, but we see a pretty big expense on here, which is amortization of $95 million on intangible assets. And what do we know about amortization expense? It's not actually a real expense. It's more of an accounting nuance to run an asset off the balance sheet that was capitalized at some point. So the way that we could reconcile this idea of, okay, we like the price to sales ratio and we don't really think this net loss is representative of the operations of the company, is we could scroll down to the statement of cash flows where we have operating, investing, and financing section. So if we look at the operating section of this statement of cash flows, the cash flows from operating activities, and we can make this a little bit bigger here, and go down to the bottom and see net cash provided by operating activities, we're actually going to see that they made $9 million last quarter in cash. So even though they had a loss on the income statement, they're generating positive cash flow from their operations, which is definitely a positive for us. And we'll see the way that these work is you have that net income number and you kind of reconcile down to the actual cash flow, and you'll see that that amortization that we talked about, that we saw on the face of the income statement, that's one of those reconciling items to get back to the positive cash flow that we see down here. But again, $9 million cash flow in a quarter on a stock that's trading at about a $1.7 billion market cap isn't anything crazy, but it does give a little bit of credence to the idea that this isn't a company that's bleeding and losing money and at risk of bankruptcy or something terrible. So again, another reason why we think the decline in the stock may be a little bit overstated. And further, if we want to talk about true earnings of a company, one place that's really, really good to look here is going to be on page 28 of these financials here, the walk that they have to adjusted EBITDA. So what is adjusted EBITDA? You'll get a little bit of flack, and maybe we can go full screen for this rant here. People will give a little bit of flack to companies that try to present adjusted EBITDA because it's seen as a non-GAAP measure, meaning not within the generally accepted accounting principles. However, like we talked about earlier, just because we see a loss of $80 million on the income statement doesn't mean that that's necessarily representative of the true financial health of the company. So what this adjusted EBITDA figure does is it takes the earnings and then adds some items back. And a lot of people use it as a proxy for cash flow. Like in the M&A environment, you'll see a lot of deals and valuations done off of the adjusted EBITDA figure because it's more representative of the ongoing operations of the company. So rant over. Let's go back to the financials and we'll see that walk to adjusted EBITDA. So there's that number again, that big gross $80 million loss that we saw in Q1. However, if we walk down here, what happens? We add back some things like the amortization because that's not a real expense. We add back some things like interest income and interest expense because those are typically capital structure related items and not necessarily representative of ongoing operations of the company. Same goes for taxes. Depreciation is in the same vein as amortization, where it's more of an accounting nuance as opposed to actual cash going out the door. So from that, we get to a reported EBITDA figure of about $10 million. And then for the adjusted EBITDA figure, we remove things that are a little bit more non-recurring. And the biggest one here is going to be the stock-based compensation. Now, I don't love the amount of stock-based compensation that they have right here. The fact that they're giving effectively $42 million in stock-based compensation. While again, that's not necessarily cash out the door. You might feel that as an investor because it dilutes the shares. But with that said, that's not necessarily representative of the company's operations. So then we walk all the way up to this figure. That's a $63 million adjusted EBITDA for Q1. And if we pull up the system calculator, we'll have $63 million times 4 quarters in a year. That's $252 million if you annualize Q1 for the course of fiscal year 2024. And with the $1.7 billion market cap, I guess we'll do 1,700 divided by 250 million. That's a 6.8x multiple on the adjusted EBITDA figure, which is kind of cheap. A lot of deals you'll see and a lot of valuations you'll see are in that 10-ish range. So this is a little bit cheap from that perspective as well. Now, we want to use the idea of a multiple here, and we want to understand why multiples are applied to companies. And the answer is because they try to forecast future growth. The only thing here that's maybe a little bit concerning from using that metric, if we go back up to the income statement here, is we'll see that when we look at, this is the cash flows, if we look at revenue, it's growing, but maybe not necessarily as big as we would like. This is like 5-ish% growth year over year from Q1 23 to Q1 24, which isn't necessarily massive and is why this stock is commanding a little bit lower of a multiple from a valuation perspective. But again, all relevant facts that we want to keep in mind. But long story short on that adjusted EBITDA walk is that this company from an operational perspective is pretty solid. There are a couple large things on the income statement that are weighing down actual earnings that get reported and some things that are more non-operational like that stock comp expense that take away from the bigger picture. But I think at the core of this company, the operations are solid and can bring in cash if this company's run a little bit more efficiently with more of a focus on the bottom line. And then one of the most important ways to value a company is to look at comps, like comparable companies in the industry. So what we've done here is we've pulled together a quick listing of comparable companies, which has come from a CFRA analyst report that they put out, I think just a day ago. So this is all pretty recent. We can see the price, but more importantly, those two valuation metrics that we really like to talk about. We can see the price to sale ratio and we can see the price to earnings ratio. What you'll notice for a lot of these, with the exception of HSTM, is that almost all of these companies are losing money. So it's not uncommon in the space. And if these were all profitable, good valued companies, I'd maybe take a step back and say, okay, this is probably in a little bit over its head with respect to the rest of the sector. But we have an average PS ratio of 2.9. So 0.63 is way better than that. And then average PE ratio here may be a little bit misleading because this is dragging the average. But you get to a negative 27 if you exclude that. Point being, most of these companies are losing money. We saw that TDOC is losing money. We dove into the financials a little bit, And I think we're more comfortable with that loss as opposed to just taking something at face value like the PE ratio. And further, why do we worry about a company when they're losing money? And the answer is typically because a company that is in distress and losing money will typically find themselves in a declining cash position. And if your cash is going down as a company, you may have to make some not so shareholder friendly decisions in order to keep the company afloat. So to further calm those fears, here's what we've got. We've got the balance sheet right here. And what we can see as of March 31st, 2024, we have $1 billion in cash on hand. And if we compare that to things that are going to be coming due for the company, the current liabilities, we see $388 million in current liabilities. So there's over 2x cash on hand to cover all of the current liabilities. And the current liabilities are effectively items in the next 12 months that the company expects to be due. AP is a very small part of that, but we have some accrued expenses, we have some deferred revenue. All is good. And the good part about deferred revenue, even though that's a current liability, that's not actually going to be cash out the door. That's just revenue that's yet to be recognized on longer term contracts. All of that to say that I feel pretty good about the way that this balance sheet looks. And even though they are losing money, this doesn't really strike me as a company that is in trouble from a cash or balance sheet perspective. So there's the quick and dirty on TDOC with some fundamental based financial analysis. And after all that, you may say, okay, well, how are we going to make money on this? So let's talk about the actual trade that we not plan to make. We've already made it at this point, but that we're kind of talking about and rationalizing for this video. So if we go take a peek at the option chain here, one thing that we really like, and maybe jumping back to the chart really quickly, is that not only is RSI low, we're going to notice that implied volatility is high. So we love to sell options. This came up on one of our option scanners, and this is an environment, the low RSI and the high IV, that is really, really favorable for option selling. So what we did, as you could probably see here, and this is on a different account, so it's not flagged. So if we pop over to our profit tracker, amongst other things, you'll see it right there in row 893, the 10 TDOC June 21st expiry, 10 strike puts for 26 cents. So the idea here is that if we sell a 10 strike put for 26 cents, our break-even price is going to be 10 minus the 26 cent premium, meaning $9.74. So if we pop back over to the TDOC chart, maybe look at it on a 1 month basis, 976 to me is a really attractive place to own this stock, especially if we zoom out a little bit. I think this is a great place to start, and we'll remember with these short-term expiries, this is only something we have to hold for 4 or 5 trading days. If we get assigned the shares, we get assigned the shares. But I think bigger picture, I'm perfectly happy to get assigned these shares. And if this thing goes from 10 and takes off to 11 or 12 before we even finish this week, and we don't get a chance to scale into these shares and play the bounce, then so be it. We'll walk away with $260 of profit. This took less than an hour for us to research, and probably took even less than that for you to watch the video. So if you've got a better 1 hour or even 10-15 minute rate of $260, good for you. But otherwise, if it does run away and all this is for nothing, $260 of profit is still a result that we're going to be happy with. But now we're actually to the end of the video. So if you made it to the end, thanks for watching. But that's why we like TDOC. That's the position that we plan to use, and hopefully it works out for us. And if you are watching this 5 days in the future, that we have $260 more than we had when I started filming this. But until next time, this has been the Hourglass Trader, where as time passes, we make money.